Hello, and a warm welcome to this Carry Forward Losses webinar. By way of introduction, my name is Dhruv, and I'm part of the professional services team at Tax Systems. The aim of today's session is to talk you through the new relief for Carry Forward Losses legislation and to show you how Alphatax deals with these calculations. Now, in terms of what will be covered in this session, we will look at the background to the rules, the carry forward loss relief focusing on streaming, pre-1 April 17 offsets, post-1 April 17 offsets, and the group relief for carry forward losses, as well as loss restriction focusing on the relevant maximum and further points to include the deductions allowance. Now, I'm going to briefly touch upon the background to the rules. The reform of the carry forward loss relief regime under corporation tax rules was first announced by government at Budget 2016. The main aim of the changes were to make the system more flexible for business while also ensuring that businesses paid tax in periods of substantial profitability. There were therefore two broad themes to the changes, being a relaxation of some of the restrictions around the use of the carry forward losses and the introduction of a restriction on the use of losses to 50% of profits. In line with the original objective, there are two main effects of the new legislation. The first is a relaxation in the restrictions on the profits against which carry forward losses may be set, with a common example here being trade losses, which previously could be carried forward and offset against future profits of the same trade only. In future, carry forward trading losses will now be available to be offset against total profits of later periods. A similar change is also introduced for your non-trade loan relationship deficits. The second effect is a restriction which now applies, which broadly means that relief for losses in excess of a 5 million allowance is now restricted to 50% of profits. The restriction is applied at 3 separate stages and applies over the top of the existing loss relief rules contained in the legislation. The new legislation itself applies with effect for accounting periods beginning on or after 1 April 17, with commencement provisions applying to computations straddling that date. Now, the very first feature of the legislative reforms to be aware of is that the new relaxation rules apply to losses arising from 1 April 17 only. The offset rules continue to apply to losses that arose before this date, and as a result, it follows that carry forward losses must now be streamed separately in the tax computation, with pre-1 April 17 losses tracked and dealt with in a different manner to post-1 April 17 losses. In Alphatax, you will see throughout the computation that we now keep track of these pre and post 1 April amounts separately on all report statements. We also now have additional inputs where required in order to affect these streams separately, such as the trade losses eliminated field, which you'll now see on screen appears twice. Streaming is required for the following types of losses: trading losses, UK property business losses, non-trade financial deficits, management expenses, and intangible fixed asset losses. We should note that the carry forward loss reforms provisions do not apply to furnished holiday lettings losses, overseas property business losses, or miscellaneous losses. Each of these may still only be set against future profits of the same type. Accordingly, these losses are not streamed in Alphatax. Now, we will look at the pre-1 April 17 offsets first. For losses where streaming is relevant, pre-1 April 17 amounts will continue to be used broadly as before. And so where you have any, you will see trade losses brought forward continuing to be offset against profits of the same trade, and non-trade financial deficits brought forward being offset against non-trade profits. There have been certain changes to the legislation. For example, relief for trading losses brought forward was previously mandatory and automatic. The legislation at Section 45, CTA 2010, now includes a new subsection 4A, which allows a company to claim to reduce the amount of the brought forward loss offset. In Alphatax, you will now see a new input on the trade losses input statement that allows you to achieve this. Entering yes or an amount into this box will reduce the loss relief applied in report mode and produce a claim note referring to that section. It is worth noting that relief for non-trade loan relationship deficits wasn't mandatory previously, but the legislation works the opposite way around in that you claim the amount of deficit you want to relieve as opposed to disclaiming trade losses. This is an example of one of the number of nuances that now exist in the carry forward losses legislation. We will now look at post-1 April 17 offsets. For losses or deficits that arose after 1 April 17, the flexibility that has been introduced in the legislation provides that trading losses and non-trading loan relationship deficits are offset against total profits. Accordingly, in Alphatax, you will see two new lines appearing in the profits chargeable report statement to reflect the amount of these losses or deficits being offset against the total profits. These offsets are also reflected in two new boxes, being boxes 263 and 285, which have been added to the deductions and relief section on page 4 of the CT600. In both cases, the offset is made by making a claim for relief, and this may be for part relief. Loss relief claims must generally be made within 2 years of the end of the accounting period concerned. Alphatax has always been the case previously will default to making the claim as far as it is available on behalf of the user, but inputs are provided in each case to choose not to claim the relief or claim a specific amount of relief should you wish to. For other types of stream losses, being UK property business losses, management expenses, and intangible fixed asset losses, relief will also continue to be available against total profits as it was before. Although the offset rules haven't changed here, streaming is required for the purposes of group relief for carry forward losses, which we will come on to next. Now, as I just mentioned, another aspect of the increased flexibility is the introduction of group relief for carry forward losses. The legislation is drawn up in a very similar way to the existing group relief provisions. There is the same concept of a group relief group with consortium relief also available, a similar process for drawing up the maximum claim between two companies as the lower of the claimable and surrenderable amounts, including considering the overlapping period between the two companies and any previous claims or surrenders. And from an administrative point of view, the notice of consent to surrender and simplifying arrangements rules are the same as well. In Alphatax, you will see we have two new statements in the CT600 supplementary forms section of the contents tree, which should look very familiar to you, being near carbon copies of the existing equivalent group relief statements. Now, the losses that are available to surrender here will be your trade losses, UK property business losses, non-trade financial deficits, management expenses, and finally, intangible fixed asset losses. There is no specified order of relief for these losses, and so you may choose whichever you wish to surrender. A number of restrictions apply on the amount that you're allowed to surrender, one of which is that a company is not allowed to surrender where it could use the loss itself. Now, where you are allowed to surrender your losses remaining, they are simply reduced by the amount you have surrendered. And Alphatax will perform a pro rata calculation where there is more than one type of loss. Overrides are available in input mode to control this allocation if you wish. For the claimant company, there are a number of restrictions that apply, such as that you may not claim where you have unused losses of your own. But where you are allowed to claim, the amount feeds into a new row on the profits chargeable report statement. This deduction applies after group relief, so according to the legislation, it is effectively after all other forms of other relief other than the carryback amounts. Any amounts claimed, again, flows into a new box, being box 312, in that same section of the CT600 that we saw before. And in addition, the CT600C now includes 2 additional pages that return details of amounts of group relief for carry forward losses claimed or surrendered. It is worth noting that the group module in Alphatax also includes a significant amount of content to assist in making these claims for group relief for carry forward losses, including a matrix that will allow for claims and surrenders to be automatically posted down to the relevant companies, and an automatic max claim calculation. Now, as we discussed at the start, in addition to the increased flexibility introduced, the new legislation also includes a restriction on the amount of carry forward losses that a company may deduct in a period. There are actually 3 separate restrictions that apply in the legislation for different types of losses. Each of the restrictions applies separately and over the top of the relevant loss relief sections and rules in the legislation. As we will see, the calculation of the amount of the restriction is applied automatically by Alphatax with very little user input, and the details are presented primarily on the carry forward loss restriction report statement. The effect of the restriction, in turn, will impact loss relief returned to the individual loss report statements, trade losses, or your non-trade financial losses, for example. Now, the restrictions themselves work by limiting the deduction of losses to a relevant maximum. This relevant maximum is arrived at by following a mechanical calculation that draws in amounts from the tax computation. The first step is to determine the company's qualifying trading and qualifying non-trading profits, and this is done by following a 5-step calculation laid out in the legislation. This starts by determining modified total profits of the company, which are essentially any profits which would be brought into account in drawing up profits chargeable to corporation tax, subject to certain modifications. These modifications include, for example, excluding company distributions, ring-fence profits, and brought forward losses. Any deductions available are then drawn up following similar rules. The modified profits are then split into trading and non-trading streams in accordance with the nature of the income, and the deductions are then also split in the manner that the company chooses. The result of these 5 steps produces qualifying trading profits and qualifying non-trading profits in step 5. Should the deductions available at step 2 exceed modified total profits at step 1, the result at step 5 is limited to nil. Now, the qualifying profits input statement in Alphatax will present details of the amounts feeding into this calculation. An override column is provided to amend any of the income of deduction amounts if required, and the allocation between trading and non-trading streams at steps 3 and 4 may also be controlled if needed. The legislation then defines the term relevant trading profits and relevant non-trading profits as qualifying profits less a deduction allowance. The deduction allowance for a standalone company is 5 million, prorated for an accounting period of less than 1 year. For a group of companies, this is a single amount that is shared, and we'll come back to touch on that process a little more further down the line. The amount of the deduction allowance that a company is entitled to must also be split between the trading and non-trading streams as the company sees fit, whilst also satisfying HMRC guidance. In this example, it is possible to see that you can create tax efficiencies in performing this allocation. The relevant maximum in your non-trading column already exceeds the losses available, and so allocating the deduction allowance here will not be beneficial. The allowance is therefore automatically allocated in full to the trading stream, where losses are higher, in order to increase the relevant maximum in that stream as far as possible. Now, Alphatax will apply this sufficient allocation automatically, and details of the calculation being performed is presented on a breakdown detail statement, which is available from the deduction allowance input statement. An override input for this allocation is also provided if required. Now, should the deductions allowance exceed qualifying profits, relevant profits are limited to nil in the legislation. The relevant maximum is then defined as 50% of relevant profits plus the deductions allowance added back, and 3 versions of this amount are calculated. The relevant maximum represents the maximum amount of losses that may be deducted under relevant sections. Those sections are broadly for the trading column, a pre-1 April 17 brought forward against trading profits. For the non-trading column, a pre-1 April 17 non-trade loan ratio deficit brought forward against non-trade profits. And for the total profits column, the sum of deductions from total profits, which will include post-1 April 17 trade losses and non-trading deficits. But note that in the case of the section 269ZD restriction, the relevant maximum is reduced by the amount of losses offset under the 2 preceding sections. Finally, in the total profits column, the restriction is having an effect on the losses deducted. As we saw earlier, this restriction does not amend the normal calculation order of profits chargeable to corporation tax, but rather applies over the top of that calculation to limit any deductions. In this case, therefore, you can see that non-trade financial deficits are offset first and in full, and this is then when the trade losses come to be offset that the restriction kicks in as the limit is reached. We shall move on to some further points now. And earlier we mentioned that the deductions allowance is shared by a group. The way the legislation is structured is that the group appoints a nominated company who holds the allowance on behalf of the group. That company may choose to allocate an amount of the deductions allowance to other members of the group as they see fit, subject to non-conterminous period limits. The nominated company retains any balance of their own computation. The group may change the nominated company, and where this is the case, the amount of the deductions allowance each nominated company is prorated amount based on the number of days for which they were nominated. The nominated company is required to submit a group allowance allocation statement to HMRC at the end of each accounting period in which it is the nominated company. The filing date for this is 1 year after the company's normal corporation tax filing deadline. This now concludes the demonstration on the carry forward losses webinar. Hopefully you found this useful. Please do use our help function if you have any queries. It's worth mentioning that details of this restriction are covered in both our new user and refresher training courses that are available via a professional services team.